Hi guys, Silver Dave here. I hope you had a good Christmas and we have the new year coming up. I put off making of videos during the period of Christmas because obviously people are celebrating. Well, hopefully you manage to celebrate yours family and things are going okay. I know it's a tough time for everybody and it's a bit complicated. Also, we didn't have any market information during the period of Christmas because most markets were closed except for the Bitcoin markets, which went crazy during Christmas. But other than that, I decided to wait a bit, gather some information, and see what might happen next year. So let's find out what might happen in 2021. Now, one of the markets I really wanted to look at because I'm interested in it. I stack silver, I stack gold, I stack platinum, but I've sort of been neglecting this market, like because honestly, I don't see there's a lot of noise in this market. It's a silver market. There's a lot of people who are constantly on YouTube telling, silver is going to go to the moon. We're going to see $100 silver, $200 silver. And anytime I post any videos where I talk imagine if the price went to zero, they freak out. Look, it's very improbable that the price of any of the precious metals where they currently are will go to zero. It's just a very improbable case. But if we're being pragmatic and we're going to talk what I think might happen to silver, if I look at the historical volatility of silver, at least during the course of, I would say, the past year, not the full historical volatility, because if you look at the full history of silver, it's going to trend upwards, right? It trends upwards, somewhat less than gold, but it does trend upwards. There are periods where it trends downwards and it lasts a few years. But right now it looks like as if we are on an upward trend. It still looks like kind of we're on an upward trend. When I look at the volatility of where it will move to sort of guesstimate a little bit of what could be the price, if we base it on historical price movement, our upper band of the price is somewhere above $30 and the lower band is above $20, slightly above. So based upon today, do I think the price of silver is going to be within these bands? I think it's going to be somewhere in between the two. Most likely it will be somewhere below $32, $34, but above $22, $21. That's the most likely scenario, right? And you're like, that's a huge range of prices. I'm like, yeah, because it's into the future. And if you look at how much it moves, to external events, silver, that's kind of what's the expected range. Can it go to, there's some people that say it will go to 100 because of the EV revolution. In my mind, it's possible, but, if you want people to have an EV revolution, you have people buying cars. And that brings me to the next part, there's no real demand. And yes, eventually there will be demand in the future, but not next year. We're in the middle of a recession. I'll go over some macroeconomic data because I've been looking at that, and there's some things that I didn't look at, and when I looked at them, it kind of scared me. I was like, oh shit, this is not great. This is pretty terrible. So personally, when I do based upon the data and sort of using the machine learning algorithm, and hopefully, I think the expected range of silver is somewhere between 30 and 26. It's not very precise. I know many people want an exact price, but nobody knows the exact price. This is sort of I wouldn't say it's the best guesstimate, but it's the best that I can come up with. I'm not a financial advisor, so it's not. Don't trade upon this information, and don't if you want to know financial advice, go to your financial advisor, not me. But what if I look at other assets like the S&P 500 and gold, well, platinum's really interesting. I'll talk about platinum in a bit, but about gold and S&P 500. S&P 500 within its normal range, right? There's a lot of QE going on. It's going to be pumped, especially if there's no fiscal stimulus. And if you look at gold is more or less flat. It's not really doing anything. If I look at the short-term volatility and where the predictor is putting it at, it's only the long term. It's sort of saying, oh, it's a little bit undervalued considering the overall situation. It should probably be higher, but it is within the range of its margin of error. There was a period, I would say, starting from July when gold went on a bull run, sort of, and it broke the expected range, and then now it's back in the expected range. 21 days also was in the expected range. There's very few times when it's below or above the expected range, which is what you should expect out of an expected range based on historical volatility. And pretty much, when you look at this and I draw out the band of the expected range, you're like, oh yeah, it's, there is some drift in the from the real price and the predicted price. And that's normal because there's always external events that you cannot account for. And that the machine system, like when I do the calculation, it does a calculation and tries to project it 14 days, 7 days, 21 days into the future. And between that time, things change. So there is drift. And the drift is, if I think like short term, what has happened previously, close range events, there's less drift compared to long term, midterm events. So yeah, there is always drift. Do I think that, gold is going to go down to zero? Like I posted that in last video. I said, like, what if there's some events people really didn't like that? They were like, oh no, you're wasting our time. I'm like, okay, well, there are meteors around the asteroid belt that do have, and there are people who are talking about mining into space. So you never know what might happen in the future. Could you say that in 2029, a new year 2020, that you were going to see what we see right now? No, nobody saw this. If you were in New Year 2019, middle of the year 2019, people are predicting like the best year would be 2020. It will be the Goldilocks economic situation. Well, look at where we are now. You can't see the future. That's what I'm saying. You can like make your predictor, say based on current day, that's a projection, and then you would have drift. Now I wanted to say something important. Nobody can see external shocks, right? Nobody has the ability to foresee 1 year in the future what will be the external shock, because nobody has a crystal ball. You cannot, you're not a fortune teller. Even fortune tellers don't tell the future. You don't have a time machine to go into the future and see what happens. So yeah, you cannot predict future shocks. This is something that all of these systems, they fail. But there are certain things, there are certain trends that you can notice, and I want to go to platinum. So 3 or 4 days ago, I said, look, platinum is right now moving out of what is the historical bands of volatility and is moving in an upward trend out of the historical bands of volatility. It could be a sign that we are going into another jump for platinum. Now, I don't know why it is. There are a few theories, I think, that could be causing this. One of it is there is an actual platinum shortage. I think back in November, the World Platinum Council said, look, we're short. We don't have enough platinum. We haven't been producing platinum because it's not a profitable metal. Gold, silver, anything else is more profitable to produce than platinum. So nobody's been producing it. And countries that produce platinum, mainly, I believe, South Africa, they've been having production issues. So there's less platinum on the market. And in addition to that, people are pricing in maybe future hydrogen cell vehicle demand. So there might be a little bit of a stockpiling of platinum going on at the moment. which could drive prices up, but I don't know how much it's going to go up. You know, the predictor says there's some upward pressure for platinum, obviously. We've seen over the past, I think, you know, if you bought platinum, I would say back in November, you're doing decently. If you manage to you didn't pay too much of a premium. I bought some platinum. I bought 1 ounce of platinum back then. I was thinking of getting another ounce, and basically I couldn't find any physical supply of platinum. Which is like, okay, that's interesting. I haven't found a single dealer who sells 1 ounce platinum coins anywhere I go where I want to buy platinum. Okay, either I have to make a minimum order of $3,000 or more, which kind of sucks. I don't want to buy like 1 month, pay out $3,000 for platinum. I wanted to cost average my platinum. I want to maybe buy 1 ounce every single month, 1 ounce every single 2 months. But apparently that's not gonna happen because, you know, I can't find any supply. And now I'm looking at it, premiums are actually going up slightly, which is, I guess, there's really, like, in terms of investment bullion, there's a physical shortage of platinum. It's kind of like, it's not as bad as palladium, which has a pretty big spread for physical investments. And also rhodium has a humongous spread. I think you can almost have like a 30% spread on rhodium, which is crazy for for bullion. Also I plugged the predictor, sort of the method of making the predictor using the different algorithm on Bitcoin, and Bitcoin's just gone crazy over the past few days, and I haven't been tracking Bitcoin price, but anyways, all the markets are more or less up from where they were back in November, right? Everything's been going trending upwards. If we look at back in March, everything's up. Everything's going upwards. And I'm thinking, like, yeah, this is not, like, it doesn't feel normal. It doesn't seem normal. And the numbers don't seem normal. Like, when things aren't normal, something has to be not working. Something has to be wrong. Something's got to give, right? People are saying like there's a problem with debt, there's a problem with like with all people's incomes. Yeah, that's true. But you wonder, why does the Federal Reserve want to print so much money, and why are they a little bit panicking? It's sort of like a Hail Mary move, like the amount of injection. Like, you don't inject as much as they're injecting unless you want it as a Hail Mary move. And I decided to look at a few macroeconomic indicators. And what I found was that, you know, since 2018, pretty much, the velocity of money, which is basically this sort of the speed of exchange, right? How often people are exchanging money, buying, transacting, is decreasing, right? You're like, what is this? For those of you who don't know, velocity of money is, to make it simple, imagine you're in a small economy, right? And you're exchanging, you make, I don't know, cows, you have cows, and you're a farmer, and you basically, every single month you want to buy a house, right? So every single month you're going out, you farm your farm, you have some cows, and you go to the farmer, and everybody has a few gold coins. You're like, okay, I want to buy a house. You give like 2 or 3 gold coins to the person who builds a house. He builds you a house. That's like sort of one transaction. And then he's like, okay, I need some more food. He comes and buys food from you. And then those exchanges, the more they are, the velocity of money increases. So in monetary theory, the basic formula when they want to do macroeconomic calculations, right, is the velocity of money is GDP divided by money supply. It's a relatively simple, like, approximation of all the transactions, because they have no way of actually tracking every single time you go and buy like bread, groceries, and they can't track that. So the way they've come up with, in theory, is the velocity of money is more or less GDP divided by money supply. And when you look at that figure and you look at their figures of what is the velocity of money, it's been dropping, right? And you're like, yeah, of course, because like people are like, you're thinking, yeah, because they printed so much money. But here's the thing. Velocity of money in macroeconomic theory is pretty much constant. You're like, what? That's not normal. Yes, it is. If you look at pre-2008, so I'm going to go back and go to pre-2008, like in the 2000s, right? Let's go back to the 2000s. Let's go back to this area here, before the current modern era. The velocity of money was always between 1.8 and 2.2. Pretty much in most economic theory, in most macroeconomic theory, the velocity of money is constant. It's constant over a long period of time. So that's why most economists tell you, like, if you print a lot of money, you will get inflation. But what we're having now is that we're printing a lot of money, but the more we print, the lower the velocity of money, which is absolutely insane. If you think about, if you're a traditional monetary economist and you tell them, look, we're in a world where we're printing so many trillions of dollars, but our velocity of money is decreasing. And in some countries, we even have negative interest rates, and our velocity of money is still decreasing. And they'll think you're completely insane. If you're talking to an economist in the 1970s or the 1980s, they would think you're completely bonkers to have that environment. But that is the reality where we are, right? And here's the thing. I'm thinking, why the hell is it happening like this? I'm using M2. M1 is also decreasing, but yeah, everywhere, every single monetary indicator is decreasing. Money stock is increasing. You can see that there's a negative correlation. There should not be a negative. It was before from history, right? If we go up to the 2005, 2010 period, it was consistently a positive correlation. Now, if you go from 2010 to today, it's an absolute inverse correlated relationship. That's very, very, it shows that the theory doesn't work anymore. And the theory is, let me go down. Where did I put it? Okay, here. That, the price times the quantity is the GDP is equal to money times the velocity of money. So if you move this area, the money, under here, in theory, you get velocity of money. Now, the traditional theory is velocity of money is constant. Quantity, whatever people need to consume, is pretty much constant over time too. And one of the components that they use to determine price, basically the only component they use to determine price, is the CPI. And part of the CPI is the Consumer Price Index. It's basically a basket of goods and services that the average consumer consumes, right? The problem with this part is that in order to get real inflation, the CPI has to go up. But I was talking to a friend who is who's better at understanding economics than I do, and I told him, look, they're printing so much money, and the velocity of money is going down. That's absolutely abnormal. He's like, yeah, in a more or less like equal economy, that shouldn't happen. I was like, so what do you mean? He said, well, it could be a symptom of massive inequality. I was like, okay, yeah. Yeah, so if it is massive inequality, I was thinking, what can I look at to see there is massive inequality? So I just went on Google and I was like, okay, what do people who have a lot of money consume? They consume luxury goods. Luxury goods are not part of CPI. And I found that like a private bank called Coutts, they do private banking and wealth management. And what they've done for their readers, actually in 2019, when the velocity was still going down, was that they're like, okay, they're telling basically to summarize, they're telling their investors and people, their target clients, that look, if you go by CPI, more or less, you're not going to be able to measure inflation. But if you go by CPI, that's a matter for you. That means the Consumer Luxury Price Index. You're actually like losing out because your inflation for luxury goods is double that of normal goods. I'm like, whoa. So what might be happening is because of inequality and the fact that luxury goods and all the goods consumed by people who are actually getting the money is not factored into the CPI. That's the simplest way I can explain this. When I see numbers like this, when I see that, you know, if you factor in luxury goods, they're exploding in terms of price, and the demand for them are exploding. Luxury goods market is a small market. It's not a very big market. As you can imagine, it's not everybody consumes luxury goods. I think, but it is still, I think, roughly in the United States equal to 0.3% of the GDP. So it's I think 60. Don't quote me on this. $65 billion worth of business, but that market is inflating at nearly double the pace of the actual consumer price index. So it means that either the people who are consuming these type of products are getting twice the amount of stimulus, or whatever type of a monetary easing outcome, they're getting twice the benefit probably compared to everybody else. And if you look at the overall assets and how the dollar is behaving, you're like, yeah, the dollar is tanking, but for it to really go down by so much, I'm benchmarking it against the Swiss franc. You can do it with a dollar index. I don't like to do it with a dollar index because a large component of that is the euro. And the euro, they do exactly the same as whatever the United States does, is that they will also do massive quantitative easing if necessary. And it leads to long-term asset price inflation. It's a known effect. You just have to look at the Dutch economy to see the level of wealth inequality there is in that country. But yeah, pretty much, if you're devaluing your currency by so much and people don't have savings or people are not increasing their wages, it's something's not working. And I think that's the part that's not working. Now, to go back into you know, our stacking stacks, what this means for our stacks is that pretty much it's going to go on an upward trend. My prediction, right, my fundamental theory is, it doesn't have to be true. It's a theory. It's not like it's true. The reason why I'm stacking gold is that I believe that gold is a purely monetary hedge. There's no physical demand aspect to it. And in a world where there is such a level where the velocity of money is decreasing, CPI is not growing, that means that the average consumer is not consuming. The only real risk component and the only way you can sort of hedge against it, there's no real inflation you can hedge, because silver, it's not a currency. It is money. It is currency-like, but it really isn't a currency. Overall, silver is an industrial metal. It's a basic commodity. I think all commodities are going to start increasing in price, but gold has this extra aspect of having the property of, or the consensus that most governments agree that gold is sort of a currency and it can be used as a currency to settle accounts between countries. So it is a hedge against the debasement of the reserve currency. Now you're like, what about Bitcoin? Can I use Bitcoin to like to hedge? Possibly, but you could also lose your shirt with Bitcoin. I've seen so many people get burned. Here's the thing with Bitcoin: governments, not all governments accept Bitcoin as a payment. All governments accept gold. The reason why they don't accept Bitcoin is no government's going to accept payment for their goods and services in currency they cannot have, they don't have control over, and they don't know who has control over, right? And that means that you're putting your hand in the face of unknown. You're like, yeah, but Bitcoin's decentralized. Yeah, but no, not really. It is decentralized in theory. The nodes can be decentralized, but mining is more and more getting into a centralized aspect. There's only a few miners who control most of the network. So if you pull all of their mining power together, they control the network. You're like, what's the matter with controlling them? Well, if they control the network, they can rewrite transactions. This is the thing. Like, people don't understand that if you control over 51% of the network and you can consistently maintain that 51% lead, you can consistently rewrite the transactions in the network. And if you control like 60, 75% of the network, then yeah, and if difficulty consistently increases and you benefit from the economy of scale, this is something that when when they designed Bitcoin, they didn't consider that there will be such large economies of scale, and you make gains on your economies of scale. Let's say you build a massive nuclear power plant next to your Bitcoin mining facility, then you definitely benefit from economies of scale, and you can outmine everybody and probably control the network. Of course, you need more than one nuclear power plant. You probably need like 5 or 6 nuclear power plants at the current state. But you know, it's a reality that Bitcoin has become more and more centralized, and miners want bigger blocks. This is, and they're kind of holding the developers hostage. You're not turning on some of the features that developers want to put in place. So yeah, I don't think governments will accept payment. Very few governments will accept payment in Bitcoin directly. Some governments might accept payment in Bitcoin, mainly smaller governments. The larger governments, they probably won't. But gold, it's for sure they will accept gold as payment. The main problem with gold is that gold has a storage cost, has physical costs, has security protection costs. They might have remelting costs. So that's why bullion gold, which is the most recognizable form of gold, and is codified in many countries' laws as investment types of gold and as basically bankable gold, and acceptable as payment. This type of gold is pretty much the best type of gold you should stack. Do I think, my theory is that because they're printing a lot of money, there's no velocity of money, no consumption, commodities prices are going to go up. How much, I don't know, whether it's a 1%, 3%, it could be anything. The predictor on the historical volatility says that, you know, silver, yes, it has a lot of potential for the upside. It also has a lot of potential for the downside, and it can be anywhere between this range. And gold it's not predicting a huge increase for gold. It's saying that like maybe we will get in the future a 10% growth from this year's relative to today's prices, and that's not a very big amount of growth. It's not like a skyrocket, but it's there. But if they keep printing money, it could be more. So that's don't trade on any of this information. It's not accurate. I don't have a crystal ball. This is just based upon math and historical information. Doesn't mean that it will hold true for the future, right? I'm assuming there's drift. I'm assuming there's some relationship between the different markets. I'm passing through this through a machine learning process to build these relationships, but it doesn't mean that correlation is causality. So that's not necessarily true, and it doesn't mean that correlation happens at every single point in time, and I cannot foresee like shocks, external shocks. So those type of things, if you really want to have financial advice and investment advice, go ask your financial advisor. They might give you some boring advice, but it will be decent. It will be at least legal advice, or legally given. And I also post some links to videos about velocity of money and how you can read up on it or watch other videos to have it better explained to you. And yeah, it's a very interesting time we're in. It's not like it's not clearly set, and it's not an easy time to navigate. So yeah, I hope you guys are looking forward to the new year and looking forward to 2021. And thank you very much for watching. You guys are great. Leave a comment below if you want to ask for anything. I'll post access to all of these predictors. I update them either daily or every 2 days, so you can see what's coming out of the machine learning process. If you have questions, just ask them in the comments and I'll reply. And usually I reply within the day or 2 days. Thank you very much for watching. Don't forget to click the like and subscribe button. Dave out.